that old adage? Buy on Rosh Hashanah, sell on Yom Kippur. Today's Yom Kippur.
No, it's the other way around.
The other way around, all right.
That's right.
We're not seeing much of a bid today.
Well, it's been a tough year for that tradition because the market was way, way up. And so you may be pious, but not profitable. So things don't work out too well this year. I think that people are becoming more and more convinced that both sides in the U.S.-China trade war need a deal. Trump would love to get one before the election, and I think Xi wants to get one to keep his economy moving, but particularly in Xi's place, he's got to try and save face in getting it done. He can't look like he's yielding to the United States, and that's the main drawback, I think.
A deal on what, though? A deal that levels the trade deficit, a deal on IP, a deal on forced trade? Nobody knows what the deal is.
No, I think it wouldn't be completely set, but I think what they want to do is, I think Trump would be satisfied if he can improve the general deficit, and China needs it because the whole basis of their growth militarily and everything else is their economy. So they can't afford to risk that.
And obviously, Shanghai market up 1% a couple days in a row. Emerging markets had this lift. You just see risk appetites kind of coming back a little bit. And of course, the bond yields, right? So we have the 7-year above 3%, the 10-year a little more above 3%. And Jeffrey Gundlach saying, look at 325 on the 30-year right now. Does it look like we've gotten some kind of escape velocity there, or is it just trading range stuff?
Well, I think this is one of the stronger moves I've seen in yields. And we'll be waiting to see. They could get to an area of breakout here pretty shortly. Now, the initial response to an incremental move up, which is what we've seen so far, is that the financials tend to like it and the rest of the market's satisfied. I think if it popped too readily, that might spook the markets, however. You know, everybody's into the fact that we're going to get a rate increase next week and possibly, probably one in December, and that's not 100% certain. But if it looked like there were going to be a series of rate hikes, I think the market might want to rethink that and see where they were.
So nothing in the bond yields moving higher that frightens you or should frighten people at this point?
Not quite yet.
Yeah.
If they got above 3.25%, then I would be somewhat concerned there.
And you mentioned the financials usually like it. They were up a little bit yesterday. Been a big laggard. I don't know if there's a way to kind of square that with what's going on.
No, I think you're right. You know, we've seen a bit of an odd rotation here. You know, the FANG stocks, which were the heroes for a while, starting to look a little bruised and battered. Facebook has been punched around pretty good. The financials were coming along. The regional banks were looking better, but as you say, that's also beginning to sputter. So yesterday's rally looked terrific price-wise. Breadth-wise, it was not so hot. The breadth was almost even between advances and decliners.
JP Morgan yesterday with a note arguing you should rotate out of U.S. assets, start taking a flyer on EM, non-dollar assets, because the sugar high will wear off, as their words, in the coming quarters. Is that a common view?
It's a very uncommon view. I think if you ask most guys down here about shifting a portfolio in that manner, you'd get a you first and see if they can begin to lift some of those assets.
Their point, though, is that the sugar high was created by fiscal stimulus from the tax policy and low rates, and we're seeing both of those things come off, but you don't think that that's a reason to start questioning where we are in U.S. stocks?
Well, I'm not entirely sure. I can't see that stocks away are that much better. You know, the emerging markets really haven't even stabilized yet, and we have to wait and see what's going on. We're having trouble in some banks in India now, so I think the emerging markets would keep me rather wary in here. So I'd hunker down with my domestic position.